Hello and welcome to the Live Beginners course presented to you by Forex Academy. My name is Robert, and over the next few weeks we will be embarking on a journey together in the study of financial markets and the trading of financial assets. There is of course risk inherent in financial trading, so please do take a moment to familiarize yourself with this disclaimer. There is just a few pieces of housekeeping before we begin. Please, as always, feel free to ask questions throughout the webinar. You can locate your chat box on the right hand of your screen with the GoToWebinar software. This live webinar is being recorded and will be placed into your members area once this webinar has concluded. And as always, we have a quick 15-minute question and answer session at the end of this live webinar. First and foremost, let's look at the key subjects as beginner traders we will be studying over the next 8 webinars. First and foremost, the objectives of financial traders. We all have personal agendas in any field of study that we go into. Trading is absolutely no different. So we must ask ourselves, what is our own personal agenda as a trader? We'll then look at financial markets and their purpose within the industry of finance, the industry, and our role as a trader. There are many different types of traders, and we need to understand what our role is before we embark on this journey. We'll then go into financial products and look at the different types, and then assess the asset classes, whether it's a foreign exchange pair, a commodity like gold. There are many different assets to choose and to trade from. And of course, the most important question we all get asked here from initial beginner standpoints: when to trade? When is a good time to enter the financial markets? The second webinar will take the construct of looking at price action and really answer the question, what is all the fuss about? Why do we enroll ourselves in this task to make money and trade the financial markets? We'll be looking at the battle for price, particularly with that price structure, Japanese candlesticks, then looking at both taking long or short positions, that's buying and selling the market. Then we'll be jumping into trading time periods. With your trading platform, you can choose to trade 5-minute time periods, 1 hour, daily time periods, and it is suited to the individual trader. Then we'll be shifting towards momentum and direction. And finally, with that momentum and direction, summing the webinar up nicely with market sentiment with trend. Webinar 3 will take the construct of the essential knowledge. The crux of trading will be first discussing how different analysts look at the market and analyze for trading decisions. Whether we're actually rational decision makers is a good question, so we will be looking at trading rationality. Some of the key elements will be brought into this lesson with liquidity, volatility, and leverage. And then we'll be finishing off lesson 3 with elements of practical trading. And that will lead us nicely into our practical workshop, lesson number 4, where we open up the MT4 trading platform, looking across the different asset classes previous from lesson 1, 2, and 3, and placing some early trades on the MT4 platform. Continuing on from that, then lesson number 5, we'll be looking at the trading toolkit, particularly how to build a toolkit. So looking at market structure, price charting, the study initially of technical analysis, and some novice principles of technical analysis 101. Webinar 6 will take us on to actually focusing on learning how to protect capital and risk management, often from a novice standpoint, a bit misguided and unforgiven, but it's so important learning how to protect your capital from day one. So we will be looking at stacking the odds with technical analysis in our favor, with attaching different levels of conviction to those trades, looking at the typical function between risk and reward and how that includes with trade exposure, and then finishing off with risk management itself. On to the next webinar, the 7th webinar, we'll be looking at becoming an active trader, just taking a step into actually practically trading and advising different assets of risk. How do we trade with micro lots, mini lots, or 0.1 lots, and what they mean? We'll be looking at different order types and trading with technical analysis with those order types. We'll be having a bit of a deeper discussion about the understanding of risk with risk on and risk off assets, and then effectively doing a little trade management before bringing this nicely into our final webinar of the series, webinar number 8, a practical workshop webinar where we will be combining all of our knowledge and expertise learned and gained and attaching a bit of practical skill to that on the MT4 platform with the practical application. Now, in aiming to become successful traders, we must acknowledge the level of competition in financial markets and ask ourselves a very important question. Why do you want to learn how to trade the financial markets? Now, it might seem quite a simple question. Of course, people will say, well, I'm in it for the money. However, it's a fantastic pursuit, actually going down the avenue of education and wanting to learn more. There is many different reasons why traders do follow this pursuit. Mainly the education, in terms of studying the markets, being a student of the financial markets, to learn and fully gain an understanding of financial markets, how they operate, and how markets and prices are determined should be a pursuit of each individual trader on the course. Of course, the opportunity, we know that there is risk inherent in financial trading, but it is within this risk, this opportunity, that allows us to involve ourselves as retail traders and eventually profit. And that, of course, leads us on to our main, I suppose, agenda as economic agents, even the profit, to apply the necessary skills that we learn as technical traders and fundamental traders to speculate on opportunities whilst protecting capital, managing risk, and of course, making money. So let's have a quick look at the objectives then of this course. We have personal agendas as traders to learn, of course, to identify opportunity and to profit from markets. Here's exactly what we'll be discussing in today's lesson. First and foremost, indeed, the objectives of financial trading. Financial markets explained. What exactly moves markets and asset prices? And then we'll be looking within those financial assets, the industry as a whole. That also will help us define our role, and it's very important, a main principle of this lesson, to define our role within the industry and what is more suited to us as retail traders to trade. We will then be looking at market access and effectively how easy it is to actually gain access to trading different financial products. That will lead us nicely onto financial derivatives, and obviously we have a preference to trading and choosing to trade contract for difference. So we'll be discussing in good depth what they are and how they operate. We'll be looking at the 5 main asset classes as well, with an addition to cryptocurrencies. We have seen them explode over the recent future there, and they are providing some good trading opportunity for the retail trader. So we'll be discussing them in some light. We'll then be looking at market selection, and I suppose the main question we get asked from lesson 1 is, how do I know what to trade? So, market selection and having a keen eye of following opportunity and which markets to trade is key from day one. And then when to trade. When do we enter the markets? When do we take long or short positions or decide to become economic trading agents to buy and sell the markets and hopefully speculate to profit? So the objectives of financial trading, obviously, when considering the financial markets and the sheer amount of traders that involve themselves in trading, there are many objectives to financial trading, or many traders simply just looking to make money. Education, in our view, is of key importance. After the financial crisis, the need for financial education has substantially grown, and that's absolutely the case. People now have a better understanding and more concern over banking and investing, and many of those risks involved that come with making financial decisions. The growth, again, in online technology has enabled a global community, including ourselves, to speculate and assume forms of risk and investment in many different asset classes. And that is indicative of the course that we are now running and have been educating traders across the world to involve themselves in understanding more about trading, banking, and investing. And we have seen changes within the industry recently there with MiFID II, the Market in Financial Instruments Directive 2, just passed in Europe in January. I'm hoping to add some education with regulation in the financial services industry itself. Speculation is key. What type of trader is actually involving themselves in the market is a good question. So in contrast to this, the more long-term traditional investor, the speculator enjoys jumping in and out of the markets more frequently. Certainly the case. Markets have become so efficient now as to move instantly when new information becomes available. Short-term profit making has now developed into a thriving new industry within the financial services sector. So if you have ever heard of high frequency trading, it's not only the proprietary trading world that is involved in short-term speculation. That's very much the role of ourselves as retail traders as well, to learn how to trade and involve ourselves in day trading and profit as markets move. Capital appreciation is concerned with long-term growth. Financial markets present opportunities that do, from demand shifts in a commodity to long-term foreign exchange appreciation from one currency or another. So there is a participant or a level of market participation in there that isn't subjectively just trying to involve themselves in speculation, but trying to appreciate maybe something they own, whether it's a full wealth of domestic currency, and hoping that there's a move. If we look at the euro in the past, certainly in 2017, it has appreciated across many currency pairs. If you're a large bank holding many deposits of euros, that might be something you'd like to position yourself in. So capital appreciation could be just important for that player. And again, capital preservation, something that we will touch on throughout the next 8 webinars, how to actually protect capital. Yes, we involve ourselves in trading, but capital preservation is certainly key for many traders. Also for big banks, we know that inflation is growing well above 2% in many areas, economic areas. So we see that value erode, and if we look to involve ourselves in trading the financial markets, that is one avenue to actually preserving capital above and beyond inflation. And of course, trading income. Day trading has grown, whether you're a prop trader or a daytime speculator. Many traders involve themselves for their sole income now. It has become their full-time job. Many of you will have the aspiration to become full-time traders. So trading income, looking at price fluctuation over different time periods, and obviously the objective is simply for making return and turning that into trading income for yourself. Let's have a quick look now in explaining financial markets and what the 4 main purposes are. So the purposes of financial markets really is to facilitate price discovery, the raising of capital, transfer of liquidity, and support and extend international trade. If we do look at them one-on-one here, price discovery is certainly one of the main facilitations of a marketplace, any marketplace where buyers and sellers interact. They discuss, they converse, they make trades, and obviously they come to a level of fair value for any particular commodity or asset they're trading. That is no different in financial markets, where nowadays liquidity is so huge. Liquidity simply being the large amount of participation in financial markets. Certainly price discovery is met between those buyers and sellers at fair value. The raising of capital is huge for a facilitation in terms of reasoning behind the financial markets. If you're a small business and you're looking for to raise some capital to grow, you may list yourself on a stock exchange and hope that shareholders will invest in your company so that you can invest in other services or the main means of your business. Capital investment is huge for financial markets, and certainly a main facilitation for their construct. The transfer of liquidity, again, we've seen capital flow. It happens all the time through economic areas from America over to Europe, a change of euros to dollars. As global business and international trade continues to grow, we see this transfer of liquidity increase paramountly and helps facilitate the reasoning behind financial markets. Supporting and extending international trade, we look at business creation, and that does tie in with all points, buyers and sellers, capital investing, capital flow. We see international trade grow, and this creates business We want other business parties from one economic area to conduct business and to grow with one another. Financial markets are like any other marketplace here. So if we look at maybe a Sunday marketplace where buyers and sellers engage in commerce, the financial markets are no different. It is this interaction between buyers and sellers that create a level of trade, question of value, and define price discovery. So price charting that we look at on our MT4 platform, it's merely the reflection of price discovery at agreed fair value. And this price discovery is often psychological and subject to human emotion. It can at times be totally irrational, and that is most certainly the case with financial markets at times. Asset prices are subject to the laws of supply and demand. Again, just like any other commodity, if there's a shift in whether it's a weather, whether there's political instability, we'll look at these explanations just in a moment. There will be a move of supply and demand function causing asset prices to move in tandem. So what moves markets? Well, I suppose as novice traders here, if we can think, over the last 6 months, if you had heard any news about maybe the market selling off recently or political instability with Brexit or anything, I would like to pose the question to our novice traders here on Webinar 1. What do you think moves financial markets? And I'll give you a moment just to type in a few answers there. Yes, I can see Simon has put instability, political instability, supply and demand. Francisco, absolutely fantastic. Yeah, we're seeing some fantastic answers come in here. And look, there's no right or wrong answer. There is an unquantifiable amount of different factors that will affect asset prices and move markets. Let's have a look at some quickly just to get an overall bearing of what moves markets. We have global trade, scarcity of natural resources, supply and demand and its function, government policy, weather, central bank decisions, political instability, and business investment. So all in all, there's a few there that you can see they're very different in terms of what part of the economy they come from, if they're at all economic, if they're governmental, if it's purely something like the weather, which is totally out of our control. All of these things obviously have an effect on many different correlated or uncorrelated asset classes. Let's have a quick look now in terms of our role as a trader and how we look to involve ourselves in financial trading. It is entirely important, and I want to make this clear, that we know, understand, and accept our role as retail traders. I wouldn't expect, even if someone has good experience coming into a novice beginners trading course, to have an unquantifiable amount of knowledge in the financial markets. We are retail traders. We haven't been trading the markets for 20, 30 years, possibly at this stage, and we know that we're at a slight disadvantage. Our role as retail traders, and we'll look at the industry in a glance, helps us understand how we can approach the markets and gives us many real advantages when doing so. So one of such would be accepting we are not the smart money and that our need for knowledge and understanding is real. And that brings us back to education, one of our personal agendas in actually studying the financial markets, that the education or the need for education, it's real. We're retail traders. We are at this moment at a disadvantage, and we're looking to find possibly an edge. Bringing us on to the second point, that competition is strong. Excuse me. Competition is strong, and we do not yet have a trading edge. We are, of course, small fish and will never be able to move markets. So that would be indicative of trying not to force any trades. No matter how much we buy something, I know market forces will relate to supply and demand and the amount of capital flow going into an asset, but us as small fish, small traders, will never be able to actually move markets. The risks, therefore, that we take must be small in comparison to other market participants. And I have a quote here that I like. For me, it works through all forms of life. Knowing who you are is the first step to realizing who you want to be. It's from a very, very well-renowned motivational speaker, Eric Thomas. For this specific lesson, knowing our role as retail traders and who we want to be as professional traders within that framework serves to actually get us there and realizing who we want to be. So let's actually look at the industry at a glance. Now I have a hierarchy chart here, and I'm just going to go through our different levels here. We have central banking. Now they're at the top of the chart. They're the top players. Macroeconomic change, quantitative easing, if you've heard anything about that, really trying to boost the economy. It is the role of the central bank to do that, not us as retail traders or even prop traders. And they will, of course, have a large move in terms of shifting market prices. We'll look at institutional trading there. Institutional trading 2 we have, which would be large capital hedge funds and wealth management funds. Institutional trading 2, which would be more in the essence of private retail banking, so your Santanders, big banks like that. Commodity brokers, pension funds would be like Aviva, mutual funds, investment funds. Then we go into the more sophisticated prop trading world, which is the divide between the retail trading world and institutional top-heavy trading. They are quite sophisticated in terms of prop trading, high-frequency trading, algorithmic trading in their set strategies, but they are still, in terms of the hierarchy, small fish to, say, for example, central bank movements of markets. And then our role, of course, as retail traders, and that would be individual trading and speculation from ourselves, thousands of global participants that make up the market, but effectively are involving themselves in the big movements from the other players to try and profit. And with that role as a retail trader, we now know that actually our market access is really quite easy, and that's a good thing, that technology has moved forward, that you don't have to necessarily go into Wall Street or find a job in Wall Street to be able to trade an asset like gold or a foreign exchange rate and actually profit in the markets. Trading online is now very easy and accessible. We can now trade with an internet, computer and internet connection. And just I'd like to make a point on that actually, as we do go through the MT4 trading platform later on throughout our later webinars, it is not a necessity to have 4 or 5 different trading screens so as to call yourself a very willing retail trader. All I would recommend would be one computer and one strong internet connection to actually involve yourself in trading the markets. It's all that's necessary at this stage. Sunday evenings to Friday evenings, 5 days a week. Obviously, the Forex markets are open, so there's plenty of time to involve yourself in trading. And obviously, in terms of access, we have brokerages that offer spread betting, CFDs, futures, options, and cryptocurrencies, many different products there to trade from. So in terms of those products, what best suits us as a retail trader, or what are we able to actually involve ourselves as retail traders? Well, that brings us on nicely to the construct of those products. How can we access the markets in such a way? And the answer is through the birth of the financial derivative. So I'd just like to take a moment to actually define a financial derivative to you. A derivative is a product which derives its value from an underlying asset. The derivative itself is simply a contract between myself and you, perhaps 2 or more parties agreeing to buy or sell at a specific price, which is based upon and replicates the value of the underlying asset. The ability to trade derivatives on asset prices allow us to simply speculate on that movement of price within and without actually physically owning the asset itself. And I'll just use oil again as an example here of that. We're not actually wanting, or do we want to actually involve ourselves in owning 1 barrel of oil? If we think that the price of oil in the next 2 months is going to rise, but we do want to make a profit in that, it is not within our interest to go to the market, buy 1 barrel of oil and and hold it in our garage here for 1 or 2 months, hoping that the price rises, to bring that back to a port perhaps to sell at a profit. It's just not practical. What we use is a financial derivative, something like a CFD, based on the underlying asset price, so that we can make a contract, an agreement with the party in the short term, speculate on the CFD with a purchase perhaps, and then selling that back into the marketplace when the price rises a few months later. So let's look at some of these financial derivatives here, and I have divided them in to better off define our role as retail traders. First, let's have a look at institutional derivatives. So we have futures contracts. Now, they're quite complex. They roll from, from 3 months to 3 months, depending on the asset you're trading. And they are a speculation of an underlying asset in future time with a settlement date. In terms of us trading them as retail trading derivatives, we need a lot of capital to actually trade a one lot, or actually have limits, what you would call for futures trading contracts. So to give you an example, if you were to trade an oil or a gold futures contract, you'd need at least 5,000 euros, roughly 3,000 to 5,000 euros to actually trade in one lot. So for taking on 3 to 4 positions in the market, probably need around 30,000 across different asset classes. It's just not available to us, given the fact that we have daily jobs, we're looking to speculate in the markets perhaps, and we need we don't have the amount of capital that perhaps a proprietary trading firm has in trading futures contracts. The same would be for options, where they are constructed differently. They are more for hedge funds that will take huge bets to cover options. But in terms of us as a retail trader, not the best product for us to involve ourselves with. Over-the-counter derivatives would be large block trades between institutions. Exchange-traded derivatives would be something like a futures contract as well. However, we also have things like exchange-traded funds, which can be bought and sold through institutions. Credit derivatives and interest rate swaps, which will actually be more constructed towards overnight money development. In terms of looking at the right here, we have spread betting, binary options, contract for difference, and cash market spots. So they'd be more relative to how we would trade the financial markets. First and foremost, spread betting is simply you can open a spread betting account online and trade against a broker or against a market maker, and allows us to take small, perhaps 50 cent or pence position per pip on any given derivative or any given asset. So it does allow us with a small amount of capital to involve ourselves in trading. Binary options as well are a fan favorite for many. However, they're simply, if I could use the word taking a bet, it would be the closest remark I would put to actually betting in the financial markets as opposed to trading the financial markets. Contracts for difference would be, of course, one of our preferred methods of actually trading, where it's a contract for difference in price between one or more parties. You buy, perhaps you take a long position and buy a market, and you agree the contract. When you want to release that position, you'll sell it back into the market. So there is a contract there, and it's based on the underlying asset price. So you're actually trading within the marketplace itself. Cash markets would be more the spot market as well. So that would be more related to yourself actually going to buy 5,000 shares perhaps in Google. You would need 5,000, the equivalent capital amount for that, or perhaps changing a large amount of foreign exchange with the bank or cash. Again, in terms of speculating across many asset classes, there are severe disadvantages to that as well. So let's try and understand financial derivatives in a little more insight. In understanding our role, as we've said, as retail trading within the environment, we can focus our attention on the various retail trading products available to us as traders. Many of these products now carry very different features, as I've said. Some have great advantages to the trader, while many have serious pitfalls. So it is important to understand what we choose to trade and why. So we'll just go through them with a little more detail. We have discussed spread betting. What they do is allow traders to simply place bets on the markets. Bets are calculated at a price per point and assumed risk from one party, the trader, to the other, the broker, i.e. the market maker. So as a bet, i.e. spread betting, total discretion on market price and liquidity is on the broker, which can have very practical implications to personal trading. Gains are, however, tax-free, so there are tax advantages to spread betting indeed. Binary options do enable traders to speculate on price of an asset at a specific time in the future. The trade is either a winner or a loser when the expiry of that option is due. Binary options are closely regarded to gambling, as Pre said. Contracts for difference allow traders to enter in a contract between buyers and sellers of an asset to speculate on price. Although the market is synthetic, it follows underlying asset prices with consistent degree of liquidity. So there is a fantastic level of participation in the CFD market, and it would be the closest we would say that actually would follow indicatively and relatively to any asset that you're actually trading. And of course, we have the cash market. So cash trading allows those to trade physically on the shares of assets at full notional value. So you will need capital to trade the cash markets. Traders will then own their investment, and large amounts of capital are however needed. So again, choosing to trade CFDs, the preferred method, I would say, for the retail trader within the environment. We prefer to trade them, and they're typically the preferred leveraged instrument to retail traders. Now, what I mean by that is, if you look at notional value, you can use your leverage, which we'll discuss throughout, to actually decide to choose to trade a notional value or a total value of 1,000 euros against a currency pair, or 10,000 euros against a currency pair, so that if there is a small price fluctuation, you are able to profit. And we do this acutely by using the CFD, or the contract for difference. Contract for difference are available on a variety of asset classes, enabling more active opportunity and portfolio diversification. And that is most certainly the case, and a huge benefit, I would say, in looking for opportunity. Particularly myself, one of the main reasons I would trade a contract for difference is if I want to trade the Forex pair, there may be 40 to 50 different currency pairs available to trade and choose from, and that if I look across those assets for opportunity, and with my technical analysis, I may be in a better position to look for good trades. Contract for difference are quite cheap to trade, and particularly Forex, which is kind of what I was relating to with leverage, that we are actually able to start a small account size and actually choose to trade a notional size of maybe 5,000 euros or 10,000 euros based on perhaps a 200, 300, 400 euro account, so that we can profit when there are actual small appreciations and depreciation of the currency itself. CFDs allow both long and short selling, and that is very important as a financial trader, as a retail trader, to know that we can short sell or sell markets, basically speculate that the price is going down and profit, and CFDs do allow this opportunity for us. Let's have a look now and go through the main asset classes that we'll be discussing and looking to trade as retail traders. We have Forex, commodities, equities, and that will involve equity indices as well, which we'll touch on. Government bonds, a fan favorite at the moment, cryptocurrencies. So we'll take them apart one by one and have a little look in greater detail. Now, foreign exchange or Forex, is probably the most popular asset to trade, given that there are many different foreign exchange pairs, both majors, minors, and more exotic pairs. Why do we like to trade them? First and foremost, well, they're regarded as safe haven cash. So you may have heard the phrase, well, why not, if the markets are volatile or risky, why not put your money under your bed? And that actually has some sense in terms of the financial marketplaces and trading. Cash is king. So there are many currencies that actually we look to invest in when times are uncertain, and these are safe haven investments. So they do provide a return on investment, and we touched on that when we discussed an appreciation. Perhaps one of the roles of traders may to be just look for capital appreciation over a long time. If we believe that the euro should rise maybe 3 or 4%, even something small in the next year, that capital appreciation may well outperform inflation and provide us with a return on investment. Trading is focused on strength versus weakness of one currency to another. And this is really the crux of Forex trading. There's no absolute secret to Forex trading. What we're trying to do is trade strength from one currency pair, perhaps the euro, to the second currency pair with weakness, perhaps the dollar. And the perfect setup that we're looking for is for one or the first currency pair to be really strong and the second leg to be very, very weak. And that should give us a very strong indication of a price rise. Now, we will discuss this throughout the webinar. Typically the most volatile of all asset classes with constant price movement. And that's certainly true. If we think of a Forex pair, absolutely there is an unquantifiable amount of economic data indicators, any political news, any news event really that sort of has a short-term shock to even over the first minute the news release comes to light. Certainly that affects the Forex markets and the Forex pairs. So they're very volatile and can shift and trade up and down quite often. Yep, there we are, an unquantifiable amount of economic variables that formulate price discovery. Foreign exchange currencies always trade in pairs, so that's worth noting, and we'll just have a look at the construct of a Forex pair. Here is the euro dollar. So if we look in blue, we have euro highlighted. That is actually what we know as the base currency. The second in red would be the dollar, and that is known as the quote currency. So basically what that means is the base currency is our first leg, the one to the left, and the one to the right, our second leg, will be our quote currency. If we look how currencies are actually quoted, just highlighted in black there and underlined 1.23376, that will simply be the quote currency price in relation to the highlighted blue of a €1 coin. So what it literally means is that the value of €1 is 1.23376 US dollars. Let's have a quick look at commodities. And now there are a wide variety of commodities to trade from, and obviously their prices. They're divided into subgroups. So main commodity groups would be energies like your oil markets, your natural gas markets. Then we'd have metals like palladium, copper, zinc, and then we'd have soft commodities, very much like your coffee that you drink in the morning, or perhaps a grain like wheat or even sugar, things like that there. Prices follow swings in supply and demand. So given that they are necessarily ground commodities, large swings, shifts in supply and demand, whether it's as a result of weather, perhaps drought, or a long period of heat, this will of course affect these commodities, particularly with large swings with seasonality. A key function of global physical trade and reflect global outlook, and this is indicative of perhaps economic growth and the commodity story. If we look at the Middle East, might be a good example to choose from, because they produce a lot of the world's oil and obviously control a lot of the supply of oil. Now, as such, there are big players in the oil market, and if there are big shifts in the price of oil, their home domestic economies will take a big shift in terms of growth or contraction as a result of the commodity itself. A key function of domestic economic performance via import and export. Again, oil is a good example to use. We can even look at Canada or Australia. These are indicative of exporting oil countries, and obviously their economic performance very much depends on the commodity, and so does the currency in terms of how the commodity is traded, importing and exporting out of the country. Now, we often provide excellent opportunity commodities as factors affecting them can change rapidly. So if you're looking to trade commodities, know that there can be great price shocks in the supply and demand function, and that provides us with opportunities. Seasonality, as I mentioned, may be one. So if there's a bit of a shock to, I know cocoa there in 2016 had its largest bear market for the longest time there in 20 years. and that was as a result of seasonality or crops drying out. Moving on to equity and equity indices. So what are they? They're designed obviously to raise operating capital for an issuing company within the markets. Investment in equities facilitates global growth and business. Equities are exchange traded, which means they're exchange traded on perhaps the New York Stock Exchange. We have Eurex there in Europe, particularly in Frankfurt or in London. These are exchange traded, and they have various opening and closing times. So be aware that they have a different functionality to the forex markets, perhaps, where they will open at a cash market price, perhaps 8 or 9 o'clock in the morning, and have their own closing times. Speculation and investment aims to make a return, and that's the point of your equity trader, particularly speculating or holding a long-term investment with the aim of making a return on income, ROI. Equities and equity indices themselves, now they are collectivized and tradable as indices reflecting top performing companies and macroeconomic activity. So to give you but a few examples, we have the S&P 500, which would be the largest component structured index in the US. We have the FTSE 100, which will be the top heavy 100 companies in the United Kingdom, making up that index. We have the Dow Jones Industrial Average again, and plenty more. We have Le CAC 40 in France there, which would be the top 40 performing companies in France, and the list goes on. Again, giving a full-on level of macroeconomic activity within the domestic nation itself. Specifically, equity trading refers to the trading of company stocks and shares. So if you're looking to be an equity trader, we must know that they're accessible via the cash markets in investing. We will need to actually pay for the shares that we want to invest in, and that means that there is a necessity for capital when actually looking. But that is, in terms of a trader, we would call that investing. And that is different to our role as a retail trader, where we're looking to speculate on these prices in the short term, perhaps with leveraged accounts. We would call that trading. So that allows it to be accessible via our retail trading platform and actually trading the price of the markets as such. Equity investing focuses on the physical purchase and ownership of company stock. As technical traders of price action, which we'll discuss obviously as a retail trader, we prefer to focus on price speculation and profit from those moves. So I wanted to have a quick look here at our FTSE 100 market here. Again, the FTSE 100 is basically a top-heavy 100, a market created of the 100 largest companies, performing companies in the UK, and indicative of a level of growth of the UK economy itself. In terms of its construction, you can see on the right hand side here, it does have a price, and that price is fully tradable. The price is simply a weighted average of the 100 companies at market price, and that will move in tandem with political instability, whether it's ongoing Brexit negotiations, whether it's a currency change or shift, and whether there's obviously good corporate earnings within the FTSE 100. Many of these conditions will allow us opportunity to trade something like an equity index. Moving on to government bonds, the issue of government debt is to fulfill borrowing requirements. So that will be their main focus. Governments must borrow to run national affairs. In effect, what they do is actually sell or issue government debt over fixed term periods. If you ever have seen a bond quoted, you should be able to buy or trade a 2-year, a 5-year, a 10-year, or even a 30-year bond. Now, effectively, what that is the government giving a loan or selling a loan for perhaps a 10-year period with an interest rate attached or a coupon attached. So they're asking for investors to invest in them, and with that investment, they will provide a short return over the duration, as we know, of the bond. Bonds are auctioned at market to determine price. So just like any other asset, they are liquid. They move in terms of their price traded between buyers and sellers, and there is a level of price discovery that is similar to every other asset out there. This price reflects the economic outlook and stability of each region as a function of perceived risk. When there is a greater risk and more uncertainty of a government bond, that region will not be able to repay its debt. The market will demand a much higher rate of return, and that's known as the yield on the debt issuance. So that does sound complex, but let me just describe it to you in a little detail. We'll take, for example, the European sovereign debt crisis, Greece, Portugal, and Italy, particularly Greece. So obviously when Greece was going through a bit of a sovereign debt crisis, there was considerable belief that they might not be able to repay their outstanding loan repayments on their bonds. And if you're not actually able to pay back your interest, to pay back your bond, there is a certain belief that investors who want to invest in your bonds or your economy will deserve a higher level of risk for taking on that risk, that trade. And so the government will have to reprice the bond and perhaps give a higher rate of return, perhaps 7 or 10% over a 10-year period, as opposed to something like very safe, perhaps the US government, which would be 1-2%. So you can see how it's all about a level of risk associated with the government and with the fact that the government is able to pay or not pay back the full duration of the bond. Cryptocurrencies are a fairly new asset, but they're making their way into, I suppose, total acceptance in terms of retail trading and in terms of professional trading. We have already seen with the birth of the Chicago Mercantile Exchange and the Chicago Board of Exchange there in the United States have actually rubber stamped and are now trading 2 futures contracts in the professional financial institutional arena. So they have been accepted in I suppose global financial markets, and that allows us opportunity as a new asset to trade from. But what are they? Well, they're digital currencies tradable in some regions in lieu of cash. They're tradable on private mining exchanges online and now entering a CFD or futures contracts. So what we need to know is, does the price move? How does it move? And are we able to profit from price speculation? And certainly the answer is yes. They're tradable 24 hours a day and 7 days a week. So from my point of view, that's fairly exciting that although the Forex pairs do trade 24/5, I would say, we have a new asset class that actually trades non-stop. And if you do want to speculate perhaps during the weekend when other markets are closed, they can often move during the weekends, and there's opportunity for traders who do want to trade at those times. One downfall, I would say, or perhaps added attachment of risk, I should say, is that they are very volatile and they do follow volatile trading conditions, given that they're relatively new, given that the markets are not entirely understood and we're still trying to formulate price discovery for them. A couple of points just to note on cryptocurrencies: large percentages of the markets are owned by very few big players. They're driven by technological growth and possible bubble speculation, and they are not able to take, we're not able to take short positions on most of the available currencies, and that is indicative and relative, to actually the cash markets themselves in the currencies. With our CFDs and trading platforms, we are indeed able to take short positions and speculate that the price will fall in these cryptocurrencies. So after going through some of the asset classes that we're able to trade, another main focus point is market selection when looking at the markets and assessing them. And I put here, stop, look and listen, almost like you're crossing the road when you're a youngster. And it's indicative of ourselves as novice traders coming into the beginner trading course here, and that we do kind of want to go through the education and know what we're doing. Market selection will help you answer that. So what markets do I trade and when? Well, with Forex, commodities, equities, and bonds, many traders will struggle to choose which markets to trade, or even worse, try and trade all of them. That would be a main flaw as a novice trader, so do be aware of that. Institutional trading attempts to build diversified portfolios over a combination of asset classes, choosing the perceived best trades at the right time whilst trying to conform to a suitable level of assumed risk is most certainly our attitude and something that we want to develop with you guys throughout the beginner trading course. And most retail traders often trade on a gut feeling with no relation to perhaps diversification or what sort of risk to attach to one trade. So we'll look to correct these flaws. We'll attempt to protect capital and erase variance so as to develop consistent performance. And one point I'd like to leave you on market selection there is there will always be another trade. You know, the markets are moving all the time, whether you're a Forex trader, whether you want to trade commodities, cryptocurrencies, or maybe all of those assets. You will miss some trades and you will catch some good trades. There will always be another trade around the corner that you'll be able to speculate and profit from. So just be aware when choosing market selection that we don't need to rush in all at once. We'll learn through our education and we'll look for those good opportunities in the markets. And we'll stop, look, and listen when we do need to assess further trading decisions. So what markets do we trade? Well, to be honest, there is no right or wrong answer. What we will look to do as traders is to strive to become better decision makers. So going through the beginner's trading course here is most certainly the task at hand to acquire the education and knowledge that will certainly help us to do this. Fundamental knowledge of a market will help your understanding, yes, of entering the market at the right time. So there are many skills to learn. You know, technical analysis is one, fundamental knowledge and a bit more insight to the markets is certainly another, and that will help you deliver decision-making quests. Our technical analysis will help answer both the what and the when. The study of price action, which we'll be discussing through webinar number 2, will offer insight into how markets move and where prices are more likely to move to. And that's what we do. We try and stack the odds in our favor. We become price action specialists. We use a little fundamental knowledge of the market we know and where the price is likely to move to, stacking the odds in our favor and make the trades across those assets we wish to trade. So in concluding webinar, we should now know what objectives are as a financial trader. Do they align with our own personal agenda, and what is our role within the marketplace? Well, we know when we have discussed why we trade the financial markets. We know that our role is the retail trader. At this moment in time, we're not as progressive to become perhaps a prop trader or anything further. What we're looking to do is confirm and solidify our role as a retail trader in profit, speculating through the MT4 platform across asset classes perhaps. The use of financial derivatives and how we can trade those assets and what we can trade. So we looked at the main asset classes, we looked at what times some of them are open at and some of the pitfalls and advantages to many of them. Quiz 1 is now available in your members login area just after the lesson in our Forex Academy members area. And that will conclude our webinar. Just with a note, the next webinar will be webinar 2. We'll see you at the same time tomorrow. We'll be discussing what is all the fuss about, particularly within that webinar, the battle for price between buyers and sellers looking for price discovery. And we'll be shedding a keen eye technically on Japanese candlesticks and how we can assess them for trading decisions. Congratulations, we have now finished the first webinar of the beginner's course. I welcome, of course, any questions whatsoever. Never question is too timid to ask. Don't think that any question is too silly at this stage or strange. We're all in this together as novice traders. Please take your time to answer a question, perhaps in the chat box there, and I'll be happy to answer your questions. Yeah, just seeing some comments coming in from George and Francisco. Yeah, you're very welcome. I hope you enjoyed the webinar, and I do hope to see you at the same time tomorrow for webinar 2. Great, I see some fantastic comments coming in there. No specific questions at this stage, so I'll be delighted to let you go, guys, and see you tomorrow. Thank you very much for joining us on the Beginner's Course. I'm Robert, and from all of us here at the Forex Academy, have a great day. We'll see you tomorrow at the same time for Webinar 2. Thanks for now. Bye-bye.